Hello, Chris.
Rich,
Good
what's
seeing you today,
going on?
man. What's happening?
Not much. Just, another great day of getting things done. So,
So, here we have our Gali Lama today again with our second podcast. And today is our focus going to be you have a home and you want to really invest into real estate. So, what could be the steps to get the best rate for your real estate investment, whether that is a rental income or a retirement income, or if you want to really move up to a bigger, better place and rent your existing place, or should you really rent your existing place or sell it? What is the real criteria to figure out the right direction for you, both financially as well as for your family needs now and in the future? Okay.
yeah, exactly. It's a great topic. Great topic,
Right.
Rich.
Right. So, Chris, today our focus is going to be really on you, not really on me. So, I have a lot of customers. I'm a real estate developer, and people come to me. Most of the people come to me, they are either second time home buyer or they already have a smaller home. They want to move up to a bigger home, or they really want to figure out some investment for themselves. So, this is really a guidance for them. So, we'll go step by step here. So let's say if somebody has a smaller home, they're living in a smaller home. A, they usually have a pretty good, rate. B, they may have already paid off that home. So now they may not even want to sell that home. What should be their starting point if they're looking at another home and now they want to see what could they qualify? Where should they start, Chris?
First of all, they got to come up with a game plan. And I always talk, I talk to many clients that come to me with this question all the time because they're looking to figure out what they want to do. So they're looking at, I already own this house right now. I have 2.5%, and I don't know what to do. I don't want to get rid of that loan, but I might need some money. So we kind of walk through the path. And that path, it looks like a couple different ways that we look down that path. I say, what is your main goal, right? Is your main goal is to grow some wealth on the back end of this and create a real estate portfolio for yourself? I would say buy your first house. If I can get them before they bought their first house, right? What I tell them is buy the house that you can easily do your step ups, right? So your first house might be a multifamily. So you're house hacking, right? You buy your first house as a 3-family and you rent out the other 2. And then the next house might be a duplex. And then the next might be a condo. And then the next one might be your single family residence, right? So now you got a portfolio of 3, 4, 5, 6 doors and now 7 with your new house. And how do you create this plan to keep stepping up? And you can multiple different ways. So for the example that you just mentioned, Rich, say you have somebody that has that smaller house and they really need to do their step up. They bought their first house because your first house is your emotional house, right? It's an emotional sale. The second one is really, you got to smarter. You got to think of it as a business deal. It's like, okay, so what's my next move on the step up? So now we look at it. How can we leverage maybe the equity that's in that home for your down payment so you're not using your own money, right? And you use that primary residence that you took advantage of because you bought it as an owner occupied house. So you took advantage of the better rates. So now you're already in a good rate at that position on that house. Some people, they don't care though, Rich. Some people are just like, they don't want to be the landlord, so they just want to do the step up, and that's fine. But we're focusing on the people that are really coming up with a game plan where they want to own some real estate, and down the road they either have some assets that they could sell, or they can continue to grow their portfolio over time into something that's substantial. So what I do is, we got to look at a few key things, right? The talking points here would be, what is the debt to income? Loan to value. And then you want to look at your rent versus mortgage coverage, right, on your house, your existing house. So, if you bought a house at 2.5 to 3%, chances are you're going to make some good income on that rental. And I've been telling everybody, especially in my market here, when they're buying their new house, I said, well, you got tons of equity. I wouldn't necessarily sell that house, which kind of hurts the housing market in a sense because we have a shortage, right?
Okay,
But
so just hold your thought right here because you are
yeah,
saying a lot of good things, and I want to make sure people understand that because not everybody has a knowledge base you have. So
yes,
you really, really said something very, very important that you already have your existing home, and your home is actually at a very low mortgage rate, or you may have already paid off 90% of the house. Now, most likely that house is going to be your humble home, like either a duplex or something. That's the case mostly. That's the reason people want to move to $2 million home. I have another video where I explain with numbers that what really should help you figure out whether you should sell or rent. Because a lot of time people live in condos and they're paying a very high condo fee. If you're paying a very high condo fee, let's say you're paying $500 a month condo fee, and your mortgage is $1,500 a month, right? So that's basically $2,000 right out the gate. Now, and then you have taxes, which you have to pay. So let's say you are paying another $500 on taxes, plus insurance you have to pay. That's $600. So basically, these are $2,600 a month you have to pay. Now, if you get a rent of $3,000 a month, then you made $400. Yes, you are positive cash flow. That's the first step. You got to see, are you past positive cash flow or negative cash flow? That's your first test. And then the second test is, what is your ROI, return on investment? So for example, you are now getting $400 net. Yes, you don't have to put anything from your pocket, positive cash flow, but you're only making $5,000 a year. So if you have $100,000 equity in it, is it a good return, right? I'm not saying this is the worst example I gave you, but I do know some people who have a very high condo fee, and then they have a low interest rate, but if your condo fee is very high, this may not be a good situation to keep the rental property. So you got to look at all those factors. The first factor is positive and negative cash flow. The second factor is, what is your return on investment? And the third rule of thumb I have is that basically, are you below 10% return or above 10%? And some people call it a cap rate. So for example, some people call it a cap rate, but I'm going totally basic. Those people who don't understand the cap rate. I'm saying, what is, for example, if you are getting $3,000 a month in my same example, and now basically your $3,000 a month mean $36,000 a year, right? If you are going $20,000 expenses, now you get $16,000, right? Now, $16,000 depending on how much money you have invested. If you are getting minimum 10 plus point return, then you are gold. In what I have seen in cities, you get more rundown, but since you get better return, actually I have seen cities giving better return than the suburbs and towns. In suburbs and towns, I live in a suburb, and believe me, even if I get 5% return, I'm a happy camper. You get better tenants, but then you get less return. Whereas if you are getting into a city, you're going to get better return, but you may have to deal with a little bit of a more hassle. And then the last point there, in my opinion, is that single family homes always give you less return than a multiplex. Do you agree?
Yeah. And I buy a lot of single, and I buy a mix of both, but I do buy a lot. But I look at my cap rate. 8% is that magic number, right? That you feel like you're kind of, especially.
So how do you define your cap rate? Because I've seen different people define differently. How do you define it?
Well, how I define it, it's I look at it in a couple different ways. So I look at I calculate the gross rental income, right? So say for example, I have a property that's making me $2,500 a month.
Again, you said gross. I just want to say, because a lot of our people don't understand this financial terminology.
Okay.
You said gross rent. Gross rent, folks, is actual rent you're getting, not subtracting anything yet. So
Nothing.
go ahead. That's rent.
Right. And let's say I own the property. You have this house that you have, right? This person has the house. They got it paid off. They're just paying those taxes, insurances, or whatnot. So let's kind of look at it in that direction, like a real example. So at $2,500, you got $30,000. I have $30,000 coming in gross a year, total amount that comes in before expenses. And now I got to subtract my operating expenses. So in this case, since I don't have a mortgage, right, I have some taxes, insurance, maintenance, management, utilities, if I'm paying those, and then HOA if there's an HOA. But let's say there's no HOA. I just got taxes, insurance, and maintenance management. right? These people pay their own utilities, and let's just say that's about 700 total a month. So it's about
Let's say
eight.
1,000. Yeah. Yeah. Let's say 1,000.
Yeah, okay, let's say 1,000. Okay, so let's put it at $12,000 a year
Yeah.
coming out. So now I take my NOI, right, which is my total amount that I have coming in.
Yeah.
My
NOI, net operating income.
That's it. So I got my net operating income coming in, right,
Mhm.
of 30,000. Now I subtract the $12,000 of expenses that I have. That's all in between my taxes, insurance, and my maintenance, and that's going to leave me with a number, right? That's going to leave me with a
18,000.
number of
18.
$18,000.
Right.
So that's my profit. So now I got to divide that my net operating income by the purchase price. But at this point, if I don't owe anything on it, then it's zero, right? It's all profit. My cap rate's going to
But
look
then,
really
then it's infinity. That is infinity. But let's talk a real example. Let's say out of that 18,000, you are paying, 12,000 for interest, or
on top
not
of it.
mortgage,
Yes,
but
yeah,
interest only. Because mortgage is interest and the amount you are paying. So let's not worry about that. Let's just because the real cost is interest only. So let's say $12,000 your interest, you left with $6,000. Now that $6,000 divided by the amount you have in equity. So let's say you have $100,000 equity. Now 6,000, that will be your 6% cap rate. You know,
correct.
that is your return on investment. So folks, we just did a quick math for you, so that if you're going to figure out what is your cap rate or what is your return on investment, they are for this exercise purpose about the same thing. Do you agree,
Correct.
Chris? Okay.
Exactly. So I mean, you said we want to kind of keep the 15 to 20. So if we just go back and say that again, here's your step by step. You calculate your gross rental income,
Right.
right? 2,500 or whatever that is, 30,000 a year. You
Yeah.
subtract that $1,000 a month,
Yeah.
which is the 12 grand. You get your 18,000. And this
Yeah.
is just an easy, simple way for someone to kind of break down the math.
Right.
Obviously, call a professional to kind of walk you through it, but this will allow you to have a little bit of an understanding before you even have that call and
Okay.
doing some research.
Okay. So a lot of those people are very professional. They know what they're doing, but we just
Correct.
want to really dummy down and understand. Now, so Chris, if somebody come to me and they say, "Hey, we already have a home. We're a second-time home buyer. We have already gotten our pre-approval, or they didn't get their pre-approval." So your advice would be to work with minimum 2 to 3 bank to get the pre-approval, or do you really work with one? What would you say, Chris?
Well, first we're going to identify what they're looking to do. So we're talking about a step up, right? They're going to move in.
Yes.
They're going to
Yes.
keep this property. So we look at different things, right? Will the rental amount that you're going to get on your home, will it support that debt, whatever that debt is, even if you own it outright, whatever? Does it make sense? If not, what type of loan are we going to do on this new house that you're going to buy? So we're going to look at different options. If you're going to go owner occ, it's very clean. We're going to look at two options, right? A conventional loan, possibly an FHA loan, depending on where their credit scores are. Now, if they're the self-employed borrower, which I have a lot of the investors that I work with are self-employed anyways. They're entrepreneurs. They're looking to buy, so they don't, they take advantage of the tax benefits that they can being self-employed. So their income at the end of the day is not enough to support what they can actually buy. So we look at alternative programs like asset depletion programs, which we can do with like 10% down. Bank statement loans, 10% down.
I think, Chris, you're going a little bit deeper. I just want to say a little on the surface. So,
Okay.
so let's say if there is a home buyer and now they really want to first get a pre-approval, understand, and then they will decide whether they're going to rent the home or whether they're going to, sell the home. Basically, the first step would be to get the pre-approval, and then when they get the pre-approval, they should let their bank know what they already have. Correct?
Correct. Yes,
So
we're going to look at all
my
your properties owned.
Right. My advice to people always is try to get a couple of pre-approval. Now they should get the pre-approval both ways. One by keeping the home and one by selling the home.
Selling the home,
Correct?
exactly.
Now, I also tell people that don't be shy that you have to sell the home because it's a liability. It may not be a liability, it may be an asset depending on your situation. So
Right.
let's the financial institution guide you and run the numbers, but be honest with your numbers. Maybe I'm a developer and you're buying from me. You don't have to give me all the numbers, but whoever you are working with, you got to be honest and give all the numbers
Correct.
because they know this house could be asset or a liability depending on how much you owe, what the rent could be, what the homeowner association fee is, what the taxes are, all those factors these people, financial institutes will run when they run their numbers, correct?
Yeah, yeah, and if it's, I mean, even right down to the linear part of it, is it in the right neighborhood? Is it
Yes.
is it in the right place where it's going to keep going up in property values? Are you in the right part of town? What's your long term play? If you're going to keep it, you might as well make sure it checks most of the boxes. That's going to make sense for you to keep it, or else it could just be an anchor.
Okay, so that is a good understanding. Now we got it that you could have a very good potential to keep your home or sell your home. You have to look at all the factors of what is your cap rate or ROI if you rent it, and then what could you afford by borrowing the money because you may want to borrow the money and because they believe most of my people believe, well, because I have a $700,000, $800,000 equity in my current duplex at home and I'm buying $2 million, that is my only equity, hence I cannot buy unless I sell it. I would say to them, don't assume that. You
Right.
may be able to use this double benefit equity, and if you have a good rental, I'll ask you one more question and then we'll move on to a subtopic here. Is that basically if they are going to keep or sell this, rent this home or sell this home, they have assumption that they don't have any other equity. This is the only equity. But if they time it properly, because let's say if I come to you and I say, look, I have this $800,000 duplex and I have $600,000 equity, but that is my only equity which I'm going to use toward my next home, and I'm buying a $2 million home, and here's my income. Well, would you not look at this if I also bring you a proposition that, hey, I can get $4,000 a month rent here, and can I use this toward my advantage that is actually giving me more income than just selling the property and using that equity? What would you say that?
Well, what I say too is I'll use rental income as income, right? So I'll go off what most banks will do is go off of the market rent. So the appraiser will go and do an appraisal, and then he'll put on there that this house will go for X amount as a market rent amount, right? And I can use that. I can use 75% of that as income, right? So we got to factor that in to support the debt. On the flip side of that, Rich, though, I'm also a realist too with the people. I say, listen, you got to know that if you don't have a renter in there, you still have that obligation of whatever the note is and the liability is on that house. So you got to factor in the good and the bad, right? So the upside, you want to make sure that, I don't want to see someone putting themselves and spreading themselves so thin that if the renter wasn't in there, they would crash and burn because they wouldn't be able to pay for that mortgage as well on the rental side. So it's a really balancing act of like saying, listen, let's see what the rental market rent will dictate. Is it much more like is it better than, or are you in a self-employed person where you don't even care if it's at break even? So there's so many different strategies in that. On a lot of mine, I don't care if I'm breaking even because I pay so much in W-2 a year. I get all that money back. So the way I look at it is I'm investing in my piggy banks. All
Yeah,
my
but
piggy banks keep appreciating.
well, there are two other benefits. One is a depreciation benefit, which
Correct.
if they sell it, they will. The other is basically the retirement 401k benefit. I mean, this could be one of the best. Honestly, I've seen real estate in the long run is the best ROI. No other,
Nothing.
Fidelity or any other account's going to give you the ROI because you are getting the depreciation benefit in the taxes,
Yep.
but at the same time your property value is increasing, and
Correct.
if you don't end up selling that and pass that to your your next generation, then that's another value. So there are
Correct.
a lot of other factors. So guys, the giveaway in this whole thing, the lesson learned is there is a lot more to it than just buying and selling. You just
Correct.
need to talk to some educated people who really know what they're doing, and then let your financial institution, your mortgage company run the numbers and be very honest and upfront with them. Be very candid that what rent you can get. If you can get a good rent, then this could be actually good cash flow and a good, asset versus liability. But if you don't do it right, this could be a liability as well.
No, and when I have my investors come to me, I have a lot of investors that come to me. I do a lot of debt service coverage loans, which we can talk on another call, which is a great program for investors. I give them their cap rate based on their mortgage amount. I show them exactly coming into the door. This is what you're looking at based on what you're going to be paying out on this house. Where you need to make sure you find the right bank. And I'm not using this as an advertising platform, but it's a serious. You got a lot of mortgage bankers that are good with just the residential market that are just talking about helping someone buy their primary residence. But you really want somebody that's intact and has some wisdom on the investment side, right? Because if you
Well,
pick
that's
the
the reason
wrong
we
banker,
have you, Chris. We gotta
yeah,
find somebody who not just a banker, but
right,
also have a neutral perspective and also broader perspective, both horizontally and vertically. That somebody
right.
like you, I'm not trying to praise you, but the reality is that you do some development. That's the horizontal, and then you also do vertical integration because you are dealing with lots and lots of banks. So it's not just one bank, because
Correct.
one bank may not be doing what people need. So you have different type of banks and investors who can provide you the solution you need. Okay, so one more quick topic, and then we got to close this thing. So the other quick topic is that basically when you go out to borrow the money, you are also thinking of, if you go to buy a, let's say you already have a home and now you are thinking of getting a rental income. Now, when you go out to get a rental income, you basically are, challenged with the right rate, because now you already have your primary residence and you're looking for a second home to rent. What are the best ways, Chris, in your opinion, to avoid high interest rate in that situation?
Well, always if you're stepping out of your house is to go with an owner occupied rate, right? You're going to get the best benefits by doing that.
How do you get the owner occupied rate, Chris, when you are getting a second home?
Well, are you meaning a second? You're going to move into this home, right, Rich?
We
Oh, your
talked about
second
that.
home.
We
Okay,
talked about the first example. Now I
right.
switched gear
So,
on you, that you already have a home. Now
yeah.
you're thinking, hey, I didn't keep my older home. I already sold it. Now after year to year, you got a bonus. You made money. Your wife is working. Your spouse is working. Now you got extra money. I encourage people to have either another or one rental property. Now you want to get a rental property. What is there a way to get the lower rate instead of getting like a sort of a commercial rate on your only one rental property?
Well, I mean, the debt service coverage ratio loans to me are the best rates for an investor. Honestly, whether it's a second home, whether it's your another investment property. I mean, I'm seeing these rates come in right now as low as 6.875, which is what you're getting on a primary.
Explain what you mean by debt service coverage. Do you mean interest only loans?
Some of these are interest only loans. Yes, you can get some of them designed where you're only paying the interest on the front end for a certain period of time, and then you're leveraging it. So maybe you have an exit strategy to sell this house in 5 years and just take advantage of the tax benefits and the depreciation that you can. With the debt, also with the debt service coverage, it's just looking at that property as an income source, right? And what's approving you is the income that property generates for you. As long as it covers the note, that's what gets you approved. So they're not even necessarily looking at your income or your tax returns. We're
Oh,
looking
good.
at the property as a
That's a very good point, folks. So, Chris, let me just explain to dummies like me. so,
yeah.
so debt service coverage loans is basically it's a special type of loan where they're not looking at your current value of the house or your assets, but what they're looking at is that what is the cap rate, what return of this particular vehicle, this new investment, vehicle you're bringing in. If this vehicle is good, everybody want to get on to the vehicle. Because
Correct.
remember, banks also are looking for good vehicles. How do bank make money? Bank don't make money by keeping the money in their wallets. Bank make money by giving you the money, but they want to make sure that there is a good vehicle. So if it is a good vehicle for you, trust me, that is a good vehicle for them.
Right.
So your strength, your credit, your assets, all those things are good. But at the same time, they want to see what is this vehicle as is going to do. Does it have a positive cash flow? What kind of cap rate is going to bring? And what are the other factors? So that's very
Yeah.
important lesson, folks. When you go out, do your due diligence and then go for debt service coverage
Yeah. And I,
vehicle. And you gotta
I
talk
just,
to educated people like Chris who
yeah.
knows what is the right program for you. Go ahead, Chris.
And I just spoke with a client today, and I just bring this up in kind of closing. And they own a property in Illinois, and they're selling their second home that's in Northport, Florida, and they're buying something here in Lakewood Ranch. And their thing is like, I'm gonna have to pull assets out of some of my accounts that are yielding me great returns right now. I don't know if I want to put down 20% because I'm going to lose money because I'm going to take out that asset. I'm going to have to pay taxes on it. So we looked at an option of just doing 10% down, which it's hard to find those programs as a second home. And you mentioned that before. So it's really, even though it's going to be their second home and they might do whatever whatever they do with it down the line, they're going to use it for half the time, right? Because they're going to come down in the winter. And I'm like, well, if you want to protect that, at this case, it was another $50,000 that they don't have to pull out. That might be, I don't know what the return is. Maybe it's 10%, but they're like, I don't want to pull that out right now, right? So I'm like, well, let's just do it as a second home, and then you only have to put 10% down. The rate's the same as an investment rate, but you protect that $50,000 you have, and now you have a way to do that, so you're not putting all your money out of your pocket to put down on this house. So you really got to look at the whole picture and give them the 2 or 3 different options that make sense and see what the best fit is for you, because everybody's different. Everyone has a unique situation, and it's right down to wherever you're pulling that money from. Where's it coming from? Is it yielding you a big return? Are you using a home equity line at interest only, right? And you can pull from that house that you own right now that you're going to keep. I've had people buy their investment properties before they move out of their house. They do a home equity line for $100,000, so they have a line of credit at prime. Say prime's at 7.75 right now, right? So now they got this free money at interest only for 10 years that they can put down on this house, and then they get some money they can put down that's available to them if they want to buy another property. So it's just how you structure it.
So, Chris, thank you very much. There's a lot to learn, and I can see there's a knowledge pouring in. And honestly, it is just a lot to share. So, folks, I will tell you that there's a lot to learn here. Stick with us because we are here for the long haul, and we are here to educate you and ourselves. And you can post the questions on YouTube. You can post the question on LinkedIn, Facebook, Twitter. We have all kind of social media. But both Chris and mine motto is to educate you. It is not really to to build a YouTube channel. It is really to educate you. That's the reason only on this channel you will see all those secrets which nobody wants to share. And there's a lot more to learn. And I hope we didn't confuse you. We educated you. If you didn't understand this first time, there's a lot to learn. You can watch this video over and over and share with your friends and then discuss it and then post questions, because your question will help us build other videos. Otherwise, I'm going to keep peeling the onion with Chris, and Chris will keep, stopping me and understanding, what's going on my side of the woods. So I think next topic we will try to have something on the development side again. Maybe next time we will talk about renovations, and what are the steps in renovations. And again, each step of real estate, each echelon of real estate, is basically portion of a value chain which has the financial piece and the technical know-how. And our goal here is to give you both sides, and I'm thinking of even bringing in people who are very, good kitchen designers, people who understand the conservations and wetland and civil engineers, and all those type of people will bring to this podcast. But stick with us and keep giving us your feedback. Until then, you have a happy, healthy, financial life. God bless you.